The stock market is still being carried by AI. But there's another chart that matters right now, and it has nothing to do with Nvidia, data centers, or earnings. It's the bond market. And the bond market just put a 5% number back on the screen. That's a big deal, because for the last few months, investors have been acting like AI can outrun almost anything. Harder inflation? AI can outrun it. Higher oil prices? AI can outrun it. Fewer Fed cuts? AI can outrun it. But once long-term government bonds are paying around 5%, the market has to answer a much harder question. If you can get close to 5% from US government debt, why would you pay any price for profits that might show up years from now? That's the problem. And it's why this bond move matters so much for the AI trade. Now, I want to be careful with the wording here. US Treasury yields aren't at all-time record highs. That's not the right way to frame it. Here's the better way to say it. Long-term yields are back near levels investors haven't really had to deal with since before the financial crisis. The Federal Reserve's latest H.15 data showed the 10-year Treasury yield at 4.59%. The 20-year was at 5.14%, and the 30-year was at 5.12%. The latest 30-year Treasury auction also cleared above 5%. So this isn't just some random move on a screen. The long end of the bond market is telling investors that money has a real price again, and that changes how every asset gets valued. Here's the simple version. A Treasury bond is basically the baseline return in the financial system. It's what investors can earn by lending to the US government, instead of taking risk somewhere else. So when that return is tiny, stocks get a lot more room to run. If a safe bond only pays 1% or 2%, then people are more willing to buy companies that might make huge profits 5 or 10 years from now. The future looks more valuable because the alternative isn't very exciting. But when a safer bond is paying closer to 5%, the whole conversation changes. Now investors can say, wait a second, why am I paying a huge price for uncertain profits later when I can get paid a decent return right now? That doesn't mean stocks have to crash, but it does mean the bar gets higher. Companies need stronger earnings. Valuations need more justification. And expensive growth stocks start to feel more pressure. That's where AI comes in. The AI story is real. Data centers are being built, chips are being bought, cloud companies are spending, power demand is rising. This isn't just a software demo anymore. It's a physical investment cycle. But the stock market isn't only paying for what's happening today, it's paying for a huge amount of future profit. And future profit is exactly the kind of thing that gets hit when rates rise. Imagine a company is expected to make $1 many years from now. When rates are low, that future dollar can be worth a lot today. But when rates rise, investors discount that future dollar more heavily. The company might still be great, the technology might still be important, but the price investors are willing to pay today can come down. That's the part people miss. A story can be true, and the stock can still be too expensive. AI can be important, and the market can still get ahead of itself. And that's basically the setup right now. Reuters reported that by Thursday's session, the S&P 500 had climbed more than 18% from its late March closing low. The Nasdaq had gained 28%, and the Philadelphia Semiconductor Index had surged more than 60% this year. That's a massive move. So when yields jump, oil prices rise, and traders start questioning the Fed path again, the market doesn't need a brand new disaster to pull back. Sometimes it just needs a reason to ask whether prices have moved too far, too quickly. And the macro backdrop is giving investors that reason. April inflation was hotter than the market wanted. Consumer prices rose 0.6% in April and 3.8% over the year. Energy prices rose 17.9% over the year. Producer prices were even hotter. The Producer Price Index rose 1.4% in April and 6.0% over the year. That matters because producer prices are the costs businesses deal with before the customer ever sees the final price. If those costs go up, companies have a choice. They can pass the cost on to customers and risk hurting demand, or they can absorb it and take the hit to margins. Neither one is great when the market is already priced for strong earnings. Then there's oil. Oil is one of those things investors can ignore until they suddenly can't. It touches transport, electricity, shipping, plastics, food distribution, and gasoline prices. So when oil rises, inflation becomes harder to dismiss as a one-month problem. Higher oil can mean stickier inflation. Stickier inflation can mean fewer Fed cuts. Fewer Fed cuts can mean higher yields, and higher yields can mean lower stock valuations. That's the chain. This is why the Fed is in such a difficult position. At its April meeting, the Fed held rates at 3.5% to 3.75%. But the rate decision wasn't the only important part. The language mattered. The Fed said inflation is elevated, partly because of the recent increase in global energy prices. It also said developments in the Middle East are adding a high level of uncertainty. So if you're the market, you can't just assume the Fed is going to step in and save risk assets. If inflation is hot and oil is unstable, cutting rates gets harder. And if cutting rates gets harder, long-term yields can stay high for longer. That pressure doesn't stop at the stock market. It moves through the real economy. Higher Treasury yields feed into mortgages, they feed into corporate borrowing, they feed into private credit, and they feed into the cost of building the AI economy itself. Data centers need chips, land, steel, cooling systems, power contracts, grid upgrades, and a lot of capital. If money gets more expensive, the build-out doesn't automatically stop, but the math gets tighter. And that's what makes this story so interesting. The bond market isn't saying AI is fake. It's asking whether AI stocks already price in a perfect future. The Federal Reserve's latest financial stability report made a similar point in a more technical way. It said equity valuations are still high. It also said the estimated equity premium is near a 20-year low. In plain English, investors aren't getting paid much extra to own stocks instead of safer assets. That can work when growth is strong and rates are falling. It's harder when yields are rising. And that's why Nvidia matters so much this week. Nvidia has become the cleanest symbol of the AI boom. If Nvidia beats expectations and gives the market another strong outlook, investors might decide the AI engine is still powerful enough to carry stocks through higher yields. But if the numbers are only okay, or if guidance isn't strong enough, the market may start treating 5% bonds like real competition. That's the tension. The bullish case is pretty straightforward. AI earnings keep surprising, capex keeps flowing, semiconductor demand stays strong, and the biggest tech companies keep turning infrastructure spending into real revenue. In that world, high yields are a headwind, but they're not a wall. The risk case is just as simple. Inflation stays sticky. Oil keeps pressure on consumers and businesses. The Fed can't cut as quickly as investors want. Long yields stay near 5%, and investors decide they no longer want to pay peak prices for future earnings. That's when leadership narrows, volatility rises, and the market gets much less forgiving. So the question isn't whether AI is real. AI is real. The question is whether the market has priced AI so aggressively that even a real boom has to be nearly perfect. That's what 5% yields do. They force discipline back into the market. They make investors compare every growth story against a safer return. They make future profits compete with present income. And they remind everyone that even the strongest themes still live inside the macro environment. The stock market can absolutely keep climbing from here. But the test has changed. It's not enough for AI to be exciting. It has to be profitable enough, fast enough, to beat a bond market that's finally paying investors again. That's the 5% problem. And right now, it might be the most important number on the screen.